I now want to bring your attention to the concept of loss aversion. Loss aversion occurs when the pain we associate with a loss is much more intense than the reward felt from a gain. And we experience this even at an early age, as you can see from this example.
I ate all your Halloween candy last night. There's no more candy left in your pumpkin. It's just trash. Oh, no. Eating all your candy when you went to sleep. I think you ate enough candy last night.
No, I only had like one bite of candy. Are you serious? Last? Oh, good for you. Now you don't have time to get a gummy. You see how much I have? I'm into a lot of houses.
I know. I ate it all. It tasted so good, especially the peanut butter cups.
Sometimes you just got to get that mom and dad tax. But as you can see from these children, kids experience this pain of loss, something that they've worked hard for, collecting candy at Halloween. When they don't get to experience that and they've been looking forward to it, they can really feel the pain of that loss. And it makes sense that as investors, we also feel that pain. When we've worked hard and we've saved and we see a decline in our portfolio, we experience that as a very real loss at times. As you can see here, this is what occurred in 2020 during the pandemic. You can see what was happening during the most uncertain times of the pandemic. So if we're thinking earlier in the year, in March and April, when things were really looking bleak, we didn't know what the response was going to be to COVID. We didn't know how soon we were going to get a vaccine. We didn't know how long the shutdowns were going to last. There was a lot of uncertainty that was going on across the globe, and that spilled over into the financial markets. And what we saw kind of at a large scale was that a lot of investors were fleeing stocks and going into cash. As you can see here, you can see there was an increase in money market funds in March and early April at the same time that the market was rebounding. So once we were starting to get more certainty from the government, we saw that the Fed was going to do whatever it took to keep interest rates incredibly low. There was a lot of stimulus from economies across the globe, and we were already starting to see stocks start to rebound here. And so essentially investors were taking money out at a time when there was maximum opportunity, and doing so can really affect your long-term returns. You know, this could be the difference between living the life that you want and then maybe running out of money too early in your life and not being able to achieve your long-term goals. So it's very important to consider loss aversion and how that can impact your decision making. Present bias. Present bias occurs when we overvalue the immediate rewards at the expense of our long-term goals. Now, this can really set folks back in their planning, particularly with their retirement planning, because we tend to become overly focused on the here and now versus what's best for the long term. If you remember earlier, we were talking about when we make decisions about what to eat. So we eat the chocolate cake instead of the salad. This is also where present bias comes into play when we make decisions about our health and fitness. You know, we may put off a new health routine. We may put off going to the gym. It's easy towards the end of the year to say, hey, I'm going to start anew in January. And we see this play out with gym memberships every year. A lot of folks get new gym memberships, go to the gym in January and February, but we see that tends to tail off later on. But that present bias can cause us to focus much more on getting immediate gratification, which may come at a cost to our long-term goals. Decisions can be challenging. When we're sitting down with folks, we find that they often have many different goals that they're trying to achieve, and working with a financial professional can help you prioritize your goals and develop a plan to achieve more of your goals. So sometimes you may have a choice between, do I want the cabin in the mountains, or do we prefer more of a condo on the beach for a vacation home? And you may have to choose either or when you're planning, but really understanding what's going to bring more meaning to you and what you really will enjoy the most can help you arrive at that decision. Maybe sometimes it's a compromise. If you're not sure if you want to spend more time at the beach or in the mountains, then maybe you look at more flexible options to achieve those goals. Getting back to this present bias and how it shows up in the numbers. So we look at this survey. This is different groups, folks in their 40s, 50s, and 60s. And to differing degrees, they are exhibiting this present bias in their planning. So you can see that individuals that are in their 40s have about a 61% tendency to prioritize the here and now, their daily expenses, paying down debt at the cost of their long-term retirement planning. That actually goes up slightly for folks in their 50s. And I think the reason for that, it's something that we will see sometimes, is that when folks are in their 50s, they tend to have a lot more competing goals, especially if you've got kids, because you've got kids that are going off to college in some cases. You've got weddings and things you may need to pay for. So there's big expenses that may come into conflict with your retirement goals. Folks that are in their 60s, they tend to get more serious about their planning. And it makes sense. They're getting closer to Social Security age. You can start drawing your Social Security as early as age 62. Age 65 is the magic number for Medicare and getting health insurance through the Medicare system. So it makes sense why people in their 60s are a little bit more motivated to prepare for retirement. Hopefully that's not too late. As you can see, we've kind of got a retirement crisis here in the United States. So if we just look at investors from the ages of 60 to 69, over 70% rather of those surveyed had less than $100,000 saved for retirement. Now that could be very concerning. Now there are folks that are above average in this situation. In fact, we see the top 10% or so tend to have over $500,000 saved for retirement. And I don't want you to get too focused on those numbers. You know, those numbers may be meaningful, but your situation may be very different. If you've got a pension that's going to cover the vast majority of your expenses in retirement, then you might not need to have as much saved as someone that's going to be relying only on their savings and Social Security. So it's really something that you want to understand through the scope of your own financial plan. Anchoring. So we often focus too heavily on one piece of information when making decisions. When we anchor on details, it can cause us to not make progress. Let's think about this. Maybe we were painting a room at one point in time, and we spend a lot of time picking out just the color of the paint. We had intended it to be a weekend project. Hey, we're going to get this knocked out on a Saturday. But if we spend half the day picking out the paint color, it's really going to set us behind in accomplishing that goal. So oftentimes we get overly focused on small details. You may have heard the saying as well, that someone or maybe an organization can't see the forest for the trees. That's another way of kind of putting this behavior of anchoring. As prices have gone up with food, I think anchoring has caused us to think back to what old costs were, and it makes it harder for us to come to grips with what current costs are. So when you think about, in our family, we really like the fresh Mex food. Our boys, could eat a burrito bowl almost every day of the week. And in 2019, if you could get a burrito bowl for $7.50, but recently it's costing closer to $15, that seems like a big outlay and a big difference, where prices have gone up. And if we anchor just on the price, we may not see that in a lot of ways, maybe some of the ingredients have gotten better. So they've introduced higher quality ingredients to the food that they're preparing. We know that labor costs have gone up, so that's a big input that's caused prices to go up. So when we anchor on price, it really takes a lot of the enjoyment we get away from experiencing certain things, because we just see the price has gone up and we focus strictly on that. So you don't want to fall into this trap of anchoring too much on a specific detail. This also can affect your investment behavior. So in this example, we've got a portfolio, and we're looking at a time period from early January 2022 to February 27th, 2024. So this is a little bit over a 2-year time period. But this was a period of time where, especially at the beginning, there was a lot of volatility when we saw markets, both stock and bond markets, go down, because we remember early 2022, the Fed was starting to raise interest rates. They raised interest rates several times in 2022 to tame inflation, and that caused both stocks and bonds to go down. And over time, this seems like a long period of time, but it was a little bit over 2 years. An investor could be looking at their portfolio and thinking, well, my portfolio is worth the same amount today as it was at the beginning of 2022. And thinking in that manner could cause you to not follow through with your investment plan. It could cause you maybe to not want to save in your 401k. You're like, well, my investments haven't been growing, but as you're saving and the market is going down in your 401k, you can benefit from what's called dollar cost averaging. So by buying a fixed amount every month, let's say you're putting in $1,000 into your 401k every month. If the market's going down, you're able to acquire more shares while that's happening. When you're saving in your 401k and we see the market go down, you should be thinking, heck yeah. But when we're looking at our overall portfolios, we don't feel that way at times, and it can lead us to bad decision making. So here is another scenario. So we're looking at a portfolio where an investor, we're looking at about a 4.5-year period. So it starts in August of 2019 and continues through almost the end of February 2024. So it's about a 4.5-year time period. And this investor is looking at their portfolio and they're saying, wow, my portfolio's grown 50% in the last 4.5 years. So do you think that's going to be more motivating for investors when they look at the long term, the big picture, and see how much progress they've made? Absolutely. And what if I told you that both of these investors were the same? It's just they're looking at it over a different time period. So in the first example and the second example, these are the same, in fact, portfolios that we're showing you, But by looking at different time periods, the short term versus the long term, they can have a much different experience in their minds. Familiarity in the home country bias. Sometimes we favor investments in products we are more familiar with. We tend to trust and like brands that we use. So if we are an Apple user, we feel better about owning Apple in our portfolio. For instance, Apple stock. This is something that can affect folks that have stock in their employer. So let's say that your employer makes contributions to a profit sharing plan, but they do so in the company stock. So because you work for that company, you may feel like that's a very safe investment. But what that can cause is it can cause a double jeopardy. What if things don't go well for that company? You could lose your job, and you could also see a big decline in your retirement savings. So you falling victim to that familiarity bias can really hurt investors. An example we can look back to in the late 90s and early 2000s was with Enron. Enron was a company that really led to they were cooking their numbers with their accounting, and once that scandal was revealed, the stock, the company basically went belly up. It's no longer a going concern. But if you worked for Enron, you lost your job, you lost a lot of potentially your retirement savings. It was a real bad situation. That did lead, one of the things that came from that is we've got better accounting standards for companies having to report their numbers. But it was not a good thing if you were, it did not protect you in the case of Enron. So that is an example where familiarity bias can affect individuals in a very adverse way. We also see this when we're meeting with clients. They may have a particular affinity for certain industries. I've got a husband and wife that I was meeting with not too long ago, and getting to know them, found out, he really loves cars. In fact, that we got to talking, and that's what he wants to retire to. So you think about do you just want to stop working? He actually wants to continue working, but more so in his hobbies of fixing up cars, working on cars. And we saw this really play out with how he picked investments in his portfolio. So some of the stocks that he had picked for himself were auto manufacturers. And he said he was a car guy, and we saw that reflected in how he was invested. But this can really affect the decisions we make with our portfolio, sometimes in a very adverse way. We also see that there's kind of a home country bias. So we tend to be weighted more so towards stocks in the country that we live. Now, this isn't just in the United States, but this is a survey of U.S. investors. And the average U.S. investor has about 80% of the stocks in their portfolio tend to be from companies that are based in the United States. And it makes sense. We're probably more familiar with those companies. They may be companies that we do business with. But if we look at, let's say that we didn't have any bias towards our investments, we would probably have about 60% of our stock investments here in the United States and 40% outside of the United States. If we're just looking at the opportunity set globally, 60% of the stocks that you could own are outside of the U.S. and 40% are, flip that, 60% are in the United States, 40% are outside of the United States. Now, that's not to say that you want to have this split in your investments if you're a U.S. investor, but being more global can play to your advantage over time to take advantage of opportunities outside the U.S. As you can see here, we think the U.S. is a very good market. It's a very tends to be a pretty stable economy. But if you look at the last 20 years, there were actually countries that performed better in terms of what their stock market returns were. You can see the number one performer was Denmark, then Indonesia was high up there, India was pretty high up there, and they outperformed the United States. So if you have all of your eggs in the U.S. basket, you may think that you're very diversified if you own like an S&P 500 index fund because you own the 500 largest companies in the U.S. But here again, over the last 20 years, you would be missing out on those opportunities outside the U.S. There can also be long periods of time where specific markets don't do very well. If you only own the S&P 500 from 2000 till the end of 2009, that's what they call the lost decade. So you would have had a period of time where even though you owned the 500 largest companies in the U.S. from the beginning of the decade to the end, you didn't really make any money. We've also seen, even over a longer period, in the 70s and 80s, Japan was one of the best performing markets, but over the last 30 years, Japan hasn't done hardly anything. So if you were a Japanese investor and you'd only invested in Japanese stocks, your portfolio would have really suffered over a long period of time. So this is why having that global view for your portfolio can be important to get better outcomes. Overconfidence bias. So overconfidence is the tendency to overestimate our own abilities and judgment. When they survey folks, they tend to say they're better than average, whether it comes to golfing, driving, making investment decisions. We tend to be overconfident. We think we're better than the average. But if you have a survey and everybody says they're better than average, that can't necessarily be true. If you've got a large enough sample of people that you've surveyed, you're going to have, to get the average, you're going to have some people that are way above average, and you're going to have folks that are perhaps well below average. And because of that, and how we overestimate our own abilities, that can cause us to get a false sense of security in our own decisions sometimes. And that can definitely hurt your investment returns. We see this can play out for investors when they have a specific, maybe there's a story or something that they heard on the news. They've been seeing a lot of reports here recently with artificial intelligence. AI is going to change the world, so I need to own only artificial intelligence companies, or I need to wait more towards these companies that are benefiting from AI. I think like NVIDIA. I mean, we've already seen NVIDIA's price go up dramatically over the last year or so, just on these developments in artificial AI. And of course, they make a lot of the chips that really power AI. But a lot of that good news may already be priced into where these stocks are now. So when you think of how the market has tended to work over time, the market is a leading indicator of things. So when things become publicly known, those stocks are already moving up. So you don't have a lot of time to react to that. So you could end up, chasing something that has already gone up. So a lot of those future returns may have already been realized from NVIDIA. Now, I'm not saying that they have, but they could have. And as investors, that's why you don't necessarily want to chase those recent performers, because they could turn around. The bubble could pop eventually, as we've seen happen a number of times throughout the history of the financial markets. So overconfidence can cause us to not necessarily make the best decisions. It can cause us to want to do a lot of things. If we become very confident that something's going to happen, it can cause us to want to trade a lot in our portfolio. Maybe we think a recession's imminent, so it could cause us to maybe get out of stocks and miss some additional gains. It can cause us to think, hey, we're never going to have another recession. I think something that's happened with this story of, hey, the Fed's trying to guide us to a soft landing where we get inflation down and we don't have a really bad recession. Some people are thinking, hey, we're not going to have a recession. Well, I guarantee you at some point we're going to have another recession. If you're invested long enough, you're likely to experience another recession. We tend to have those about every 7 years or so. Now, if we're thinking back to Star Trek, I don't know if we've got any Star Trek fans watching this from home, but we can kind of contrast the two characters of Spock and Dr. McCoy. If we think of McCoy, he was very emotional. He tended to be very impulsive in the decisions that he made. He liked to make decisions with his gut. Whereas with Spock, he was very methodical. He was very logical in his decision making. He tried to look at all of the evidence and all of the facts and circumstances before he made a very measured decision. Now, there are times in life when we do have to make quick, abrupt decisions. When we're driving and a dog runs out in front of us, we may have to hit the brakes. We have to act very quickly. We may have to turn the steering wheel to get out of the way. But when it comes to our investing, these are things we shouldn't be making very quick, abrupt decisions about. We need to come to a plan that makes sense for us in terms of our investment strategy, and we need to try to stick to that over time unless things have changed. Maybe things have changed in our circumstances, and that may be a time to revisit our investment strategy. But if you want to be a more successful investor, if you think of it as being more like Spock than McCoy when it comes to your investment strategy, that can be very helpful. So how can you do that? Well, one way is try not to watch as much of the financial media. The financial media is not really there to educate us. It's there to sell advertising and really get engagement with their viewers. So they don't really have incentives to help you make money. And another thing to do is folks that tend to look at their portfolio less tend to do better. They tend to be happier with their progress if they're not looking at things throughout the day or every day. So if you're looking at your portfolio maybe once a month or once a quarter, you're going to tend to be happier with the progress that you're making over time versus looking at it every day. Because the more often you look at your portfolio, the more likely you're going to see it down from the all-time high. And that can be demotivating as an investor. We also think that a way or a secret weapon to counteract some of these behavioral biases is just having a financial plan that guides your investment strategy. So knowing what your goals are, knowing what all resources you have to achieve your goals, and having a very well thought out plan that you can refer back to over time and keep you focused on your investment strategy. It can also prompt you, maybe when you've achieved goals, maybe you can change your investment strategy. Now that I've achieved this goal, maybe I don't need to take as much risk in other parts of my portfolio. So that's where having a financial plan can lead to better decision making for yourself. Now, this is a study from Vanguard. Now, a lot of people remember that Vanguard has really popularized the use of index funds, and They didn't actually create the index fund, but they popularized it. But what you can see is even Vanguard, that's kind of made their name through low cost investing, they believe that investors can benefit from good financial advice. So you can see here, this was a study that they did. It's called the Advisors Alpha Study. And basically what they found that for financial advisors that are implementing a lot of best practices within financial planning, they were able to provide better outcomes for their clients. So if you look at the different areas, the thing that we're talking about today, behavioral coaching and just providing perspective and helping investors make better decisions and avoid some of these mistakes, can lead to better outcomes. It could lead to up to 2% a year in a better outcome. If we look at all of these different services that an advisor could be providing, it could increase outcomes by 3% per year in terms of net returns to the investor. Now, everybody's mileage is going to vary for this. So I want to be very clear that this is not any type of guarantee that if you work with a financial advisor, you're going to do better. But if they are providing a lot of these services, it can be valuable over time to folks. So questions, you may have had some questions, so I encourage you to reach out if you do have questions about any of this content that we've posted. We want you to improve your own financial circumstances. So information without action doesn't do you any good. So I'd encourage you to maybe list just a few takeaways. You know, how can you use this to become a better investor? Does it prompt you to seek help from a financial advisor? Maybe it just means that you seek help from somebody that's maybe a more experienced investor. So you find somebody that can maybe be a mentor for you and help you make better financial decisions. Maybe it's a family member in your life that you can, an older family member that's got more experience that can potentially help guide you in this, in behaving better when it comes to your investment strategy and getting better outcomes. Now, one thing I want to leave you with, we've talked about the psychology of investing, and really one of the thought leaders in behavioral economics and behavioral finance is Dr. Daniel Crosby. He's in Alabama. He's a PhD. He started off more in a clinical setting and has over time he's written and co-written, I think, about 8 books on behavioral finance. He's got a new book that just came out. But from one of his books, The Laws of Wealth, one of the things he says is, if you're passionate about making money, make dispassionate decisions. And I would hope that if you're watching this, you are very passionate about making money. So I think this is a great way to think about investing and how you should make decisions. So if you want to do better, it's better to have less emotion involved in your investment decisions. Thank you for watching along. We appreciate you. Feel free to like and subscribe to the channel. If you feel like this would be helpful for somebody else, please feel free to share it with somebody you care about. Thanks again, and we'll see you real soon.